Okay, good morning, good morning, good morning. Again, we're going to get started. We have 23 people that's already chiming in. Hopefully, you can hear us clearly. My name again is Dr. Allen. I am the Vice President of the Broward County Business and Professional Women's Network. And I would like to welcome everyone to the Wealth Multiplier, building financial mastery and a lasting legacy. You still have time to text, send out an email to a friend, family member, or any guests that you think may benefit from this program this morning. And it is an economic development program. The objective is to empower professional women with investment strategies, build personal wealth, and create substantial financial foundations that support both their future and philanthropy endeavors. Okay, so we'll begin this program with the opening prayer by Miss Althea Perkins from the Greater Memphis Area Club. If you're on the line. Miss Althea, are you present, Miss Perkins?
She is muted.
She is muted, okay.
Sister Perkins, you need to unmute.
Is the chaplain for the Greater Memphis Club.
Let's see if I can find her. And
I see her.
Unmute her. As to unmute.
Hello?
Good morning. You're welcome to start us with our opening prayer. Thank you so much.
Thank you. Psalms 156 states, "Let everything that has breath praise the Lord. Praise ye the Lord." Almighty God, we gratefully acknowledge that every perfect gift and every good thing we have received is from you. We thank you for your multitude of mercy and overflowing grace to which we owe everything. We thank you for your faithfulness. We trust in your promises. Lord, refresh our souls daily with joys. Lord, may we never be hasty in judgment and always be generous. Let us take time to breathe. Let us grow calm, serene, and gentle. Lord, empower us into holiness as we walk in a way that is consistent with your wonderful love. Lord, we long to be a bright beacon of light in a world of darkness. Grant us wisdom, the will, and the power to work together as sisters. Diligent in our duties, faithful in devotion, filled with compassion. And Lord, let us not forget to be kind. May our service be acceptable in your sight. In Jesus' name I pray. Amen.
Amen. Thank you so very much, Sister Perkins. Thank you very much. Now we would like to present my president and pastor of the Broward County Business and Professional Women's Network, Dr. Renee Cambridge, to bring the welcome.
Thank you, Dr. Allen. Good morning, everyone, and welcome to the Wealth Multiplier, building financial mastery and lasting legacy. I'm Dr. Renee Cambridge, president of the Broward County Business and Professional Women's Network. It is also my honor to bring greetings on behalf of the participating club presidents and members from Jasper, Greater Memphis, Vicksburg, TMAC, South Florida, and Miami-Dade, along with our Broward County Club. Today, we honor each president, each club leader, and every member serving in excellence. At this time, it is my privilege to introduce our Southeast District Governor, Governor Nikki Baker, who will offer brief greetings. Following the governor's remarks, the program will return to our host, Dr. Deborah Allen. Governor Baker, we welcome you.
Good morning. Good morning, everyone. I am pleased to be here to greet you. And I just want to say how excited I am about this workshop this morning with Mr. Ralph Colimon. The clubs that are here today are very exciting because you've been working together the past few years to do programs like this. And as you know, our theme this year, as we always are moving forward with a purpose, but this year we are moving forward with the purpose and we are unstoppable. And I believe from the research I've done on Mr. Colimon from South Florida, which is my hometown, he's doing great work there. And I believe truly if you practice the principles that he's going to share with you today, it truly will render us unstoppable. So I am so excited that your clubs are able to take this information and take it back into your communities and grow unstoppably. And I thank you for inviting me this morning. Enjoy.
Thank you, Governor Nikki Baker, for your greetings. Dr. Deborah Allen, Vice President of the Broward County Business and Professional Women's Network, the program is back in your hands.
Thank you so much, Dr. Cambridge, and our governor, elitist Governor Baker. Okay, now let's move forward with the purpose and have Miss Jenny Drake from the Vicksburg Club present our pledge and our mission.
Good morning, everyone. Our pledge. As a member of the National Association of Negro Business and Professional Women's Clubs, Incorporated, I pledge to become involved, to be constant, cooperative, enthusiastic, and concerned about the problems and social ills affecting the young people of my community. I will help to promote the interests of business and professional women and invest myself in the willing service of others. Our mission statement. Our mission is to promote and protect the interests of African American business and professional women, to serve as advisors for young people seeking to enter business and professions, to improve the quality of life in our local and global communities, and to foster good fellowship. Thank you all.
Thank you, Ms. Drake, President. Okay, now we don't want to hold you up. I know it's a lot of meat that we want to get through this morning. So, Mr. Ralph Colimon, Legacy Investment Advisor. Here's a bio from him. I know you read part of it, but let me give you some more information. Mr. Ralph Colimon is a highly experienced financial services professional, drawing on over 20 years of industry expertise in the industry. His strong foundation is rooted in his Bachelor of Science degree in finance from Florida International University. He has honed his skills in building and maintaining effective relationships with customers and partners, right? Such as investment advisors, business banking, and mortgage specialists to enhance the customer experience and deepen the relationship. Currently serving as Senior Premier Branch of the Premier Banker, Ralph proactively acquires and deepens affluent customers and small businesses relationships by leveraging strategic internal partnerships to deliver holistic financial plans. He independently analyzes customer financial information, including income, assets, and credit. Okay, wow, to develop customized banking, credit, and investment solutions. Okay, so we're going to welcome Mr. Colimon, and you have the liberty to go ahead. Everybody, let's set up a hand clap for Mr. Colimon. You can do that through your reactions, and we will appreciate him taking the floor.
Good morning, everyone. Good morning. Thank you. I'm going to ask if the moderator will give me the ability to screen share. Throughout, I would absolutely like to share some information. I'd like it to be as interactive as possible. I want to share tools that you can use beyond our meeting here this morning. So some of that will just be things that are readily available online. So I'm going to check here if I have the opportunity to screen share. And it looks like I do, which is great. Okay, perfect. Before I start screen sharing, I'm just going to cover some things in general, then I'm going to cover some items specifically through screen share. I first want to start with generational wealth. That is kind of like been the buzz topic the last 5 or 6 years. How do I develop generational wealth? How do I pass on wealth to my heirs, to my family members? We first have to think about establishing wealth, right? And once we establish wealth, or prior to establishing wealth, we need a basis. So let's talk about that basis. For the most part, most individuals' wealth is tied into their home, into their primary residence. And how do you now pass that primary residence on to family without them fighting, without having to go through probate, without having to pay a bunch of attorney's fees? And sometimes, unfortunately, homes get lost where they don't pass to the next generation. We have to be proactive in asking for help. In the state of Florida, which I'm in the state of Florida, we have what's called an enhanced life estate deed. Nickname is a ladybird deed. Not all states have this. I would say it's important to check if your state has it. In essence, what you are doing, the short version is this. You are creating a beneficiary for your home, the same way you would create a beneficiary for your checking account or your savings account at your local bank. That beneficiary at the local bank walks in with a death certificate. They don't have to see an attorney. They don't have to go to a court. They avoid probate. The same thing can be done with the home. So now imagine a grandparent, a parent has lived in this home 50, 60 years. It's accumulated in value and there's no beneficiary. So now there are 5 or 6 different people potentially fighting over that home, and no one can make a decision on what to do with that home. Now it's locked up in probate, which eventually it will get out. But the costs and the fees, sometimes the inheriting family members do not have the funds to go through probate, and in essence have to sell the home. And that is not creating generational wealth, right? What we want is that home to be within the family and continue to accumulate and appreciate in value. So getting with an estate planning attorney is key. What an estate planning attorney will help you do is establish these ahead of time. Another thing that we do quite often, just the general public, we kind of wait till our parent or grandparent is on their deathbed and then start figuring out, is everything in order? We have to get everything in order now, prior to becoming at the state of incapacitation or where decisions need to be made last minute. So, a estate planning attorney, it's an absolute necessity. There is some cost there, of course, but nothing comes for free, obviously. What that attorney will do is help define your wishes when you are no longer alive. I'll give you an example. You've accumulated $5 million of wealth. And I want you guys to think about this actively. Think about 3 or 4 family members that you feel that you're just going to give them $5 million and they're going to know what to do with that money. How long will that money last? Will it last a year, 2, 3, 4? Honestly, think about that. Now, what a estate planning attorney will help you do is establish a trust. And you can define within that trust how that money is distributed. So you may decide to say, well, look, I would like these 3 or 4 family members to receive X amount per year. This is how you can continue to allow those funds to continue growing, continue leaving them invested, which preferably they should be invested, and those funds be distributed over a period of time. So now you've created a plan in advance for generational wealth. One of the things that I'd like you to do, if you have not seen an estate planning attorney, is to put that on your checklist as something that you have to do before the end of this year. Interview them. Just don't go with the first person. Have a conversation about your family dynamics, about your assets, about any debt that you may have. And how can you protect your assets and continue to have those assets flowing from potentially your kids to grandkids? And how can that be established and set up? For yourself, in the event that you are ill, for example, who's going to make the decisions on your behalf? Who's going to manage your finances? Who's going to pay the mortgage if you are ill, incapacitated in the hospital, and unable to make a decision for yourself? A lot of money is lost through those type of times for family member. Homes get lost during that time. I would also ask you to partner with someone, family member, friend, and the two of you do it together. Sometimes having a buddy, and like if you work out, if you got a workout partner, they're motivating you. You know, you can't let your workout partner down. If your partner says, meet me at 6 a.m. at the gym, even if you don't feel like it, you kind of have to be there because you can't let them down. Add that to the checklist. Pick a friend, family member, a cousin, a coworker, someone that you're close to, and partner and hold each other accountable to getting this done. This is the core basic piece to passing along wealth and ensuring that wealth doesn't get squandered. So again, the trust can be established in a way that you are setting forth what you want done with these funds. You can have a minor child, for example. Minor child cannot inherit any cash. I'm just going to make something up here. You've got a 4-year-old. You've placed your 4-year-old grandchild or child as a beneficiary. That child cannot inherit those funds. But you can set forth within a trust for the trust to inherit those funds and how those funds are to be administered to care for that child, because maybe you do want that child cared for. They might be in private school. You want their college tuition to be taken care of, and the trust will set forth that. I'm not going to go too much more in depth in it, but as you can see, I really find it to be valuable. Personally, I have it for my family. Once I got married and had my first child, I have 3, by the way. It was established, and each time, and for myself, as you grow that family, you have to go back and make edits, right? So once I had the second child, I've got to go back and make edits to include that second child. Had the third child, have to go back and make edits to add the third child. And there's expectations of them before those funds are received. And how do they receive those funds, the frequency of those funds, in addition to, can it go on into perpetuity? Can it go on to my grandchildren? So the estate planning attorney will help you establish all of that. And these are some core principles that are required in generational wealth. Because again, I may just pass the funds to child A, and child A squanders those funds in 2 or 3 years. So partner with someone. I'm going to pause there and ask, anyone have any questions? Now, keep in mind, I'm not an estate planning attorney, but I do open the accounts. I review the documents. And again, personally, I have it for myself. And don't be shy. So feel free to ask some questions there. Again, I want this to be as interactive as possible.
There's a question in the chat. Janet Robertson, would you like to ask, or would you like me to ask it?
Let's take a look here. I'm going to open up the chat and take a look at that question. Is the Ladybird deed different than a will or take precedence over a will? Very good question there. It is different. A will is subject to probate, meaning that you leave funds to your sister and you leave nothing to your brother. It can be contested. Your brother could come and say, well, no, you know what? She told me verbally, and there can be a battle over those funds. So wills can be contested. When you have a beneficiary, which the Ladybird deed in essence, in just plain language, is leaving a beneficiary. There's no contesting that, right? You have a savings account with $1,000 and you have family member A. Family member A walks in with the death certificate. They are listed as the beneficiary. There's no contesting that. So it is different than a will. The Ladybird trust, the Ladybird deed is specifically just for your housing, and it does avoid the court process. It would be done, the transfer of ownership would be done at the county clerk's office, and an attorney on the back end is not needed. You would need either an attorney or a title company to create the Ladybird deed. And so to share with you the way that works, while you're alive, you have complete control over that property. It's your property. It's your primary residence. It only takes into effect in the event if you become deceased. The same way with your checking or savings account, you are sole owner of that account. It is titled as, I saw someone put TOD. TOD is transfer on death, or there's also POD, payable on death. They both mean the same thing. It would transfer to the person or the trust or individuals that you have set forth that you want to be the owner. So yes, it would be separate from a will. What your will is going to have, if you have a trust, you can retitle bank accounts, investment accounts to trust. You can have the trust be a beneficiary. Your will quite often is going to include things that do not have any title to them. You have a coin collection of value. There's no registration or title to that coin collection. So you can't necessarily title it to your trust or title it to an account. So the will quite often is going to include things that do not have a title. But for property, for accounts, investment accounts, etc., you would want to get with an estate planning attorney and title it in a fashion to, again, avoid probate and avoid, honestly, look, family members, right? We want to avoid fighting. And again, a will can be contested. Can you protect assets acquired before marriage? Yes, absolutely. You can protect assets acquired before marriage. This, again, an estate planning attorney would be great at helping along with this. And quite often we don't like to talk about it, but a prenuptial agreement, right? Where I think, with a prenuptial agreement, the perception of that agreement tends to be very negative. It's like, oh, well, you're preparing for divorce, right? Well, for some people, they may need it. And it all depends on the two individuals, on their approach. Some couples will say, look, everything is mine, everything is yours, we share everything. Some will say, well, look, I've amassed a career prior to us becoming together and amassed assets prior to becoming together, or acquired debt prior to becoming together. That prenuptial agreement is going to be more like a plan. I think if people approach it as a plan and not so much that I'm preparing for divorce, yeah, I think it becomes a little bit more beneficial. And yes, you have the opportunity within that document to set forth moving forward, these are how the assets will be commingled. Prior to X date, it stays in line with each individual person. Now, the other part again, developing trust. You can have independent trusts for your assets prior to. So the assets in that trust are the assets of that trust and are not commingled within the marriage. So again, the estate planning attorney would be able to help with that. So as you can see, there are a lot of benefits to getting with an estate planning attorney and being honest about everything and setting forth everything, and they will be able to help you kind of guide through, again, whether you're a couple that everything's commingled, or some of the things will be separated and some of the things will be put together. So this also, generational wealth. Divorce is horrible, right? Not just the costs of the attorneys, but now you've got to split everything and you're fighting over how you're going to split it. You're forced selling, fire selling a home. The couple planning in advance, or the individual by themselves planning in advance, really helps towards having some success. Let me see if there's any other question here. Okay, no other questions there as it relates to that. Okay, perfect. I'm going to move on to the next area here. So the next area, I'm going to share some tools. So let me go to my screen share here. Okay, great. Let me know if everyone can see this. Show of hands, thumbs up.
Yes, we can see it.
Okay, awesome. Very simple tool. This is investor.gov. So this is a government website that shares information and shares some tools. And I love it because it's very easy to use and very simple. and it shows the power of compounding. I've mentioned that I've got a 10-year-old, an 8-year-old, and a 3-year-old. The faster that you can invest for yourself, faster you can invest for your grandchildren or children, the power of time and compounding is beneficial. I'm going to go through some examples here of how this can be done. So all three of my children's college education at this point, my 3-year-old's still accumulating. For the 10 and 8-year-old, they're already done. And I'll just show you exactly how that worked. Initial investment. Each of my children, as soon as they were born, had a Social Security number. I opened up an investment account for them right away. With that, I started with the initial $3,000. So we're going to actually do this application here right now, right? So it's $3,000 as initial. Monthly contribution, each child gets $150 invested for them on a monthly basis. Expectation is 18 years, should be their first year at the college level. Interest rate, you estimate what you believe. And in this case, I do this for a living, so I kind of know exactly what it is. So they generate 15% per year in their accounts. So the variance here is you may be off by a couple of percentage points. So you can put a variance. So for this example, I'm going to put 3%. I could be off by 3%, meaning that over the 18 years, they actually, on an annual basis, earn 3% less, or they can earn 3% more. And I'm compounding annually. So compounding is I've earned, just for simple terms, I've got $1,000. I've earned 15% on that $1,000. I now have $1,150. And then moving forward, I earn interest on top of that $150 that was earned the prior year. So each year it's compounding on itself. So now I calculate, and the results in 18 years, you will have $173,000. This is based on 15%. The variance here, I could be off. If I'm off by 3%, and you can see the lower variance below, and it actually earns 12% as opposed to 15, it's 123,000. Now, if things are great and it's 18%, now it's 245,000. Either way, whether it's at 12%, 15, or 18, I've been very consistent and just putting away $150, right? And you can see, think about what we throw $150 away a month on, right? Whether it's fine dining, brunch, meeting friends for whatever that might potentially be. And 2 or 3 months after that, that $150 is just, it wasn't a second thought. We're here, slow growth. So the next thing I want to talk about is that expectation. A lot of questions that I get quite often is, look, I've got X amount of money. How can I double this? We have to stop thinking through that process of how can I double it. No one can predict the future in the sense of buy stock, A, buy cryptocurrency, B, whatever that is, and this is gonna double your money. If anybody really knew that, they would sell everything they possibly could, their house, their kids, they would sell blood, they would sell everything they could if you could really predict that, but it's not possible. But if you are consistent, time will be your friend. It's just like getting a college education, we go through elementary school, middle school, high school, college. We have gone through 20-something years of life. And finally, we have this degree. Our investment life works the exact same way. Growing wealth is the exact same way. It's an accumulation over time. Now, this was a very small number of $150 a month. So now imagine you increase that. Let me share a little bit more information here. Let me scroll up here. So this table here will show each year how things accumulated. And as you can see, it's a pretty slow growth, but it builds on top of itself. It totally builds on top of itself. Now, at $150 a month, it's getting down to the bottom here, year 18, whether it's 245, 173, 123, we actually didn't invest that much in principal. Our principal amount that we've put in is way lower than that. It's the compounding growth that has increased. Now, let's just play around with the numbers a little bit. I'm gonna use $500 a month, which is a car payment for many people, right? And now there's some that are way above that, but 500 is a very typical car payment. So let's say you bought a car with $3,000 as a down payment. You've got a $500 a month payment. Now, if you did that, that money would be in the car while the car is depreciating in value. We all like nice cars. I like a nice car too. But when we really think about our cars, these are one of the areas that drain us of future wealth. Myself personally, I drive about an hour and 15 minutes to get to work, about an hour and a half back home. So that's 2 hours and 45 minutes out of 24 hours. Once I'm home, the car is parked and it's sitting there and it's depreciating in value. Now, my investment account, doesn't matter what I'm doing. For example, I own Apple. Apple's working 24/7. I don't have to do anything. Apple is continuously making money, but my car is outside depreciating value. When I'm at work, it's sitting in the parking lot and it's depreciating in value. So let's go through the scenario. $3,000 down payment, $500 monthly payment. I'll adjust this instead of 18 years. I'll decrease it to a lower number, let's say 12 years, and keep the same estimated interest. So at the end of 12-year scenario, I'd have $190,000 with whatever I would have with my regular car payment. And I share this because in actuality, this is how I operate for myself personally. I will buy a vehicle and I will keep that vehicle for as long as possible in order to grow my net worth as much as possible. One of the downfalls that we do when we think about, can we afford something? We're actually thinking about the monthly payment. We're not thinking about the impact that it has towards our net worth. So the next thing I'd like you to focus on and think about an application this year is, what is your net worth? If it's negative, what's causing it to be negative? How do you turn that around? If it's positive, what are the steps that you can take to continue to grow it? What have you been doing well, and what can you improve upon? The goal that we really want to get to, we want to get to having enough assets where those assets will pay for everything else. If you've got $1 million in assets that are generating you 7% a year, that's $70,000 a year that the asset is generating for you. Now, if that asset, whether it's real estate, whether it's stocks, whether it's a business that you own, if it can continue producing, the base value will continue to go up and you will continue to still earn some income. So the net worth is the next piece. So you get your estate plan done. You need to have that basis. Then you want to take a look of, where am I? Where am I truly? And again, when we think about affordability, we think about, well, I can make that payment, but we really shouldn't think about that. How does this payment or this purchase of, again, let's say a vehicle, impact me 5 years, 10 years, 15 years down the line? It's creating a plan. And like a business needs a plan. You go to the SBA to make an acquisition of a business. The SBA is going to want a plan. You go to a private credit firm and you want to borrow money to acquire a business, they would like a plan. That plan should consist of, how's the business going to operate? What are the contingencies? What are the projections? We want to do the same thing. We got a question? Trudy, is that you there? I see you lit up. You got a question for me?
Oh.
Trudy James Brown. No question. Okay, good. Like, okay, you're on mute. So you can see how compounding interest really works and how it really helps. So again, just kind of going back to this scenario, this is a typical car payment. Now, mind you, the car payment's not going to run for 12 years, but you can see how consistency can change things greatly. But at some point, I'm going to give you another example here. I'm just going to use, let's say some point you get to 250,000, you feel very comfortable, and you say, hey, you know what, I'm not going to contribute anything else. I feel very comfortable with where I'm at in having uh assets. I'm going to start living. So that contribution I was making, I'm just going to use that now to live my life. And let's stretch this out to about a 15-year time frame. And you are no longer contributing, you're no longer investing, but you now have a base lump sum. So with you no longer adding anything, but just staying completely invested, again, just using a round number of 250, and you no longer add anything else whatsoever, 15 years later, again, if 15% are the typical returns for my kids. I myself, I'm a bit more aggressive. Mine are higher, but these are reasonable. 2 million or at 15 years. And again, and I mentioned, let's just say using 7% returns, you have $2 million at 7%, you decide of the growth, I'm going to take 7% of that growth to live on. That's 140,000 a year in income to you while the asset continues growing. Now, as the asset continues growing, if you stay at that steady pace of, let's say, a 7% withdrawal rate, your income increases every year. So we really want to get to that base of having that positive net worth and then letting it do for itself and let it continue to grow. All right, I'm going to pause there too and ask any questions anybody has, whether it's in the chat, whether you want to come off mute. I'd be happy to answer any questions as it relates to compound interest, putting funds away on a monthly basis, or having a lump sum that you get started with.
I have a question, Mr. Colimon. You said time is a factor. Is it too late to get in the game, or
Good question.
how does that work with
It is
age?
never too late. So in our industry, Warren Buffett is like the prime example. Everyone uses Warren Buffett as the example. His net worth right now, I don't know, 150 billion, 175 billion, and he's donated billions and billions well before he's even gotten to this range. And so the conversation about Warren Buffett is that he became a billionaire, I think, at like 55 years old. And so the $200 billion that he became worth at some point was done all after he was 55 years old of just compound interest of where it was just growing very slowly at 12% a year. And quite often people are like, he's a dinosaur, but it just continues rolling and it continues going. But no, it's never too late. The reality of it is we have no idea how long we are going to live. And another key point I think that's important is to not think about it as our money, but to think about it as our grandkids' money. When we start to have a longer time horizon, when we think about the funds as someone else's funds, that we need to take good care of those funds, we start to treat our money a little bit different. When it's about me and just me, then of course I'm just going to do whatever, I want to do because it's mine. But and not saying that that's a problem, that's fine if that's the goal. Now, if someone has a goal of leaving assets for their children, for their grandchildren, or if they don't have any children, for a niece, a nephew, for charity, then you start to think about, well, some of this is actually not mine. Some of this is actually for the future generation or for that cause. And yeah, we may live to 100. And that's another reason of having assets, right? You don't want to outlive your money and you don't want to work forever. So having accumulated a good amount and being wise with it is definitely helpful. think there might have been, let me see here. There's a question in the chat. Let's see if I can see it here. No, I don't.
Mr. Coleman, there were
So no.
two in the chat, but I think they related more to the previous section.
Okay.
I'll read them to you if it helps.
Yes,
And
please.
and maybe then we might have more from this segment. But one was, what was the difference between the Lady Bird deed and the trust? And the
Yeah,
other
we covered
was,
that one.
okay, and what was your thoughts about the dynasty trust?
So the dynasty trust, there are different trust laws in different states. So some states allow that trusts have to at some point be dissolved, and it's a really really long time for the dissolution of that. The dynasty trust can almost go into perpetuity, and with the dynasty trust, not every estate planning attorney actually executes them because they're not available in every state, and they're generally going to be your extremely high net worth individuals that are interested in a dynasty trust, like um, the Rockefellers, Walmart family, for example, where they are truly looking at having these funds just last forever. So it is a good option. This is where interviewing estate planners comes in because not everyone executes them. So it is an option, definitely. And then it now comes down to interviewing to find someone that can execute it. But yes, it's definitely one that you could put on the list to learn about. And keep in mind with the attorneys, when you're having these initial conversations, they're not charging you for the initial conversation. They're going to charge you now when it comes to, okay, we now need to execute these documents. So you've decided to retain them to execute those documents. But getting the information, there's no cost. It's just your time, and it's very valuable to do so. I'm going to share, as I mentioned, I'm in the state of Florida. One of the things that I'm going to share, pensions. Everyone feels very comfortable with the pension, but not everyone feels comfortable with investing. Some of you may know this, some may not, but I'll share the information anyway. Pension plans, those funds are invested. The only way for a corporation, for a state, for a county, for a school, district to be able to pay for police officer, fire, whatever role it is, those funds have to be invested. And the short version of how that works basically is for every year that you are employed there, there's a certain amount of money that gets invested on your behalf. For those like myself that work for an employer or those that are self-employed, you're putting the funds away on your own, where those with the pension, they are putting it away on your behalf. So I'm going to share some information here regarding pensions. And let me go to the top here. So I had some of this already prepared. Let's go to page 1 here. So this is the Florida Retirement System Pension Plan. So for those of you that are in Florida and have heard of the FRS, this is the FRS. The Florida Retirement System Plan, a variety of public workers funds, their pension plans are within the Florida Retirement System Plan. Now, this document, as you can see, is pretty large, right? It's 244 pages, but I only want to highlight some items that are important to be aware of. This is the statement of assets for the Florida retirement system. So you can see here, and I'm going to use my my mouse here. We have cash equivalents, treasury investment pools. Treasuries are liquid. I'm not going to go into super detail, but they're similar to cash. Treasuries are funds that are with the United States Treasury, with the Federal Reserve System. So total cash equivalents here, as you can see, we're just going to use round numbers, 229. Now let's go down here to investments. You can see the big gap in the amount of investments compared to the amount of cash. That cash is only needed for very, very short-term use. And that maybe current payouts that are due this coming month are going to be in cash, but the majority of everything is going to be in some sort of investments. We have some real basic certificates of deposits, that's CDs. U.S. government federal guaranteed obligations. These are going to be bonds of the federal government. Federal agencies, Fannie Mae, Freddie Mac would be like an agency. Some of these are a little bit complex. Commercial paper, repurchase agreements, these are all short-term investments. Bonds and notes are going to be longer. Bonds can be up to 30 years on bonds. So these are international bonds and notes. Bonds and notes, these are going to be U.S. bonds and notes, and I'll give you a short version of what that is. Walmart wants to build 100 more stores, as opposed to Walmart using cash, and Walmart's not getting a regular mortgage. Walmart is issuing a bond. And what that bond is basically a loan. If we invest in a Walmart bond, we are lending Walmart money to go and build their 100 stores, and then Walmart pays us interest. There are government bonds, there are commercial bonds, and so let's say Walmart is going to be your commercial bond. So that's what bonds are. Notes are going to be the same. Notes are going to be shorter. So you heard the term car note. I've got to pay my car note. That's a shorter term loan. That's going to be your 5-year loan. That's going to be 10 years or less. Your bond is going to be more than 10 years. So a note is same thing. It's a loan. Instead of us paying a car note, the owner of that note is receiving the payment. Real estate contracts, mutual funds. Mutual funds, we are all going to have access to. We all have access to all of these, actually. Domestic equity. Domestic equity is going to be U.S. stocks. That's what domestic equity is going to be. Alternative investment is going to be private businesses. SpaceX is a private business. It's not available for acquisition to the general public. And there's a variety of different businesses and a variety of different investments that are going to consider alternative. International equity. These are international stocks. They could be in Europe. They could be in Japan. They could be in China. They could be in Mexico. These are international. Other investments they have not broken down here. But I'm sharing this to share that, again, everyone feels very, very comfortable with a pension, but not exactly comfortable with investing. Now, everyone doesn't know the mechanics behind the pension, but feel very secure that it's going to be there for them when they retire. Now, we can think about ourselves and how do we establish, in essence, a pension for ourselves. We're just copying the same system. So in my world in investing, what we're doing is this. We are taking your funds and we are figuring out what is your goal, what is your timeline, and establishing a variety of different investments to meet your goal and to meet your timeline of what you are trying to accomplish. Now, all of these funds are distributed across all of these different categories, and even within those categories, it's distributed even more within those categories. So let's say domestic equity, there are basically about 4,000 different stocks in different industries. So that's all being allocated in a way to meet the goal of the pension plan and to be able to pay the retiree in perpetuity. So that pension is set up in a way that you are going to be paid for the rest of your life. There's also the option to say, hey, I'd like the lump sum. You take the lump sum and then you have control over it. Again, the importance of long-term planning. The pension plans are planning for the long term, 20-year, 25-year, 30-year, depending on how that pension is set up. We want to set up ourselves for the same way. The difficulty in doing that is social media, because there's people all over social media. I did this, I did that. There's also the news cycle. Now, I keep track of Bloomberg and CNBC every day, but for the average person kind of looking at it, you feel like you're missing out. Well, this stock did this, so let me go buy that. But that one didn't do well, so let me go buy that. Well, my cousin told me this. Well, my coworker told me this, and we're kind of just like all over the place. And our emotion does not help us stay consistent. When it comes to the pension, some companies or some counties will give a statement. You get that statement, you're fine. You don't see the day-to-day fluctuations in the value of your pension plan. these plans, everything that's in here, except for the cash items, they're not fluctuating every day. But all the rest here, they can fluctuate in value every single day. But the manager of the pension plan is not making a decision every day, every week, and changing what those are. They are making a decision, a long-term decision in how the allocation is set up. I see we got something in the chat here, or at least it popped up for me. Okay, a comment. Yes, very good comment. So the consistency. So we will, be with our employer again 20 to 30 years, and we get that payout at the end of that time frame. We can establish the same for ourselves, establish the same for our children, and it can be smaller amounts. There's no right or wrong amount. It's just a matter of doing it and staying consistent at doing it. And this is where the professional comes in, and the professional helps you with this. Now, of course, there are a lot of people that feel like, hey, I can do it on my own. Potentially, yes. I think there's a small percentage of individuals that can, but it is a job to be able to do so. And I will tell you, the Florida retirement system, California retirement system, all of these systems, all of these pension plans, there are employees that are there, but they hire third-party investors to actually manage those funds for the employee. Now, I'm going to move on to, I don't have that much time. I'm going to move on to one more thing that I love, which you don't have to do, but I want to show you how it works. I love the research part. And again, these are tools that are readily available to everyone. So this is Google Finance. And I mentioned Apple earlier. You can go to Google Finance and just do whatever, any type of basic research or in-depth research that you'd like. So this was Friday's close of Apple. Apple's per share value at the end of that day was $259 on that one day. So this chart will stretch out to as long as you want. So let's do 5 years. Over the past 5 years, as of Friday moving back, Apple has grown 96% over that 5-year term. So had you invested $132 5 years ago, it'd be $259 today. Now, the reason I want to show this is, as you can see, it's not a straight up arrow. It's up and down, up and down, up and down, up and down, up and down. There's a lot of trading that's happening in between there. And some of that is individuals, some of that are your trading firms. Now, the part that I like to look at is this. Let's look at the income, because this truly is more feasible. This is the revenue of Apple in 2021. $365 billion in revenue, $94 billion in net income. Let's fast forward 5 years later, $416 billion in revenue, $112 billion in net income. So they are consistently growing, and they're not necessarily at this point a super exciting cutting edge company, but they are a consistent grower. I'll pull up one more here. Let's see. AI has been like the big thing, right? NVIDIA is considered, at the forefront of AI. All the companies need the NVIDIA chips. And let's take out NVIDIA over the past 5 years. NVIDIA over the past 5 years is up almost 1,300% in 5 years. Now, I don't care what anybody says. No one knew this was going to happen. The company has been existing for a very, very long time. AI has become very new. The AI researchers, NVIDIA was predominantly making chips. Like your PC, your laptop likely has an NVIDIA graphics chip in there, a graphics processor unit in there. And AI scientists have found that these graphics cards are actually really great for processing data, and they have the best chip for processing data. But no one knew this was gonna happen. Now, again, what I like to look at, I look at a lot as I'm researching, but I just want to share some of the real basics. So now let's take a look at their revenue. In 2021, they had $16 billion of revenue. And as the AI talk has gone up over the past year, 2 years, you can see how their revenue has extremely shot up. It's 130 billion in revenue compared to 16 billion in revenue just 5 years prior. It's almost 10 times, tenfold. Look at their net income, 72 billion in net income, where their net income prior to was 4 billion, almost 20 times as far as their net income. So there is some research that is done. These are real businesses. So when people are just kind of discussing stocks, what's going to do well, this was up or that was down. These are real businesses, and approaching investment as a real business is extremely important. Now, I don't necessarily recommend anyone just kind of go out and buying individual stocks. There are ETFs that will buy a basket of these, mutual funds that will buy a basket of these, where you're not making those individual decisions, but you have to do something. It has to be done. Now, real estate is also another option. We tend to be really, really good at real estate because we're not looking at the price go up every day, right? Where your stock portfolio, you can go on your phone. You can look at it every day, watch it go up and down every day. Real estate, that's not happening. So from an emotional standpoint, real estate is a lot more secure. It's more safe because you're not looking at the value going up and down. And so we tend to hold on to real estate for a really long time, and it tends to do well because of that. It's our patience, it's our emotion, and managing money and making decisions with money. When I'm meeting with clients, a lot of it is emotional. A lot of it is, how do you feel about what you're doing? How do you feel about your decisions? And I will tell you, if you're not comfortable, you're not going to be successful. Copying what someone else did, another family member, a friend, whatever, they can be extremely successful, but if emotionally it does not speak to you, it will not work for you. That there's no specific one size fits all. All plans and all decisions are done on an individual basis. But again, kind of taking it back to the original, you need the basics done. You need to have that plan. Get with an estate planning attorney, have a plan. You get with a financial planner, you have a plan for growth. That plan will be a short term, a medium term, and a long term, because we have different goals. I have a goal this year of um, remodeling my house or adding an addition. I've got a 5-year goal that I've got a child going to college. I've got a 20-year goal that I am going to retire. And so all of these are different buckets. And how do you plan in advance today to get there? Where again, time is your friend, and Mrs. Allen, Miss Deborah Allen, it's never too late. We always want to plan it. We start the new year off. I want to save some money. I want to lose some weight, right? That's just for this year, and that's fine. But what's this look like 5 years or 10 years from now? So anyway, I'm going to stop there because I love this. I could keep going, but I want to leave it open for Q&A.
Okay. Thank you so much, Mr. Colimon. Excellent information. Even if you take away one nugget, that is sufficient for today. Now we're going to go into our Q&A. We do have an electronic survey that we may bring up. It's only 3 questions shortly. But if you have anything in the Q&A, you can put it in there. I had one question.
Sure.
When it comes to historical and currently, we're also seeing it. I'm seeing it in my family. Thank you so much. Y'all put them hand claps up there. Thumbs up. He did an excellent job in such a short time.
They get lazy and food is not as good. I do like a Waffle House.
Okay, here I am. The question
Like
is
when me a Waffle and a Fiesta omelet.
Hi, we have someone that is talking. Okay, so when a person is deceased and they're on your property deed, how complicated is it to get that person off when you have siblings? Does that make sense?
It does. It depends if they're going to contest it or not, right?
Okay.
So
I heard
again,
of the heirs agreement. I'm not sure of that yet, but
so again, that's not my specific area, right? So my
okay.
specific area is more investing and planning. But because of the work that I do communicate frequently with estate planning attorneys and then have to help clients with their plans. So that particular agreement, I'm not familiar with it. So I wish I had an answer for you.
No worries, no worries. Just a question. Anyone else have any questions in the
I
chat?
have a question.
Mhm.
I have a question. This is
Yes, Ms.
Bernadine.
Bush.
I'm wondering, is there such thing as an insurance trust?
So there are ILETs, and I'm insurance licensed, and so but I'm going to share this. People that specialize in just insurance only and they're just insurance selling, I tend not to be a fan of, and I'll explain that. I'll explain why. Insurance, particularly life insurance, is really made for taking care of your family in the event of your death. The way insurance is quite often sold as an investment product. Now, insurance companies do provide some investments. Now, the insurance companies, when they take our premiums, the insurance company is investing our premiums, whether it's car insurance, home insurance, life insurance, all insurance. Those premiums are being taken, and those premiums are being invested with a certain amount of cash available for payouts. Insurance comes in well with, again, I've got a family. I want to make sure my family's taken care of. A basic term life insurance policy covers generally what's going to be needed. That's going to be the cheapest policy. Um, some of the insurance trusts add some complexity when the complexity is not necessarily needed. And you'll hear quite often from insurance salespeople, oh, the growth, it's not taxable, you don't pay any tax. Really, what you're doing there's two components with those policies. You have an insurance policy, which is basically like a term policy, and then you have a cash component that's invested.
Mhm.
So that portion that's invested, you can borrow against that. So when they're saying, oh, it's tax free, if you take those funds out, you're going to pay taxes. Borrowing against the insurance policy, there's no taxes because you're borrowing money. If I get a personal loan, if I borrow a car, if I borrow against my mortgage, all loans do not have taxes tied to them, period. So when that is used as a selling point, it's kind of misleading, so to speak. In addition to, you can borrow against um, your own personal investment. So if you have an investment with your bank, with your credit union, or whomever that might be, you can borrow against those investments. So for myself personally, I feel that insurance is, and again, I'm insurance licensed. There are some good products, but in general terms, I think most people are fine with a term policy and with making a decision on the amount that is needed. You're kind of making a decision of, I am so first and foremost, if someone has nobody to take care of, they shouldn't buy life insurance. So life insurance people will still sell that product even though you have no one that you need to take care of. Let's just say you have adult children, they're totally doing fine, and it's just you and you're taking care of yourself. They're doing well. You're just wasting money buying insurance at that point if your family members are fine. So on a personal level, I think term life with an amount that makes sense for what your family needs. So in general terms, you're looking at 20 times uh, whatever your income is, your salary is. So you make $100,000 a year, 20 times that is going to be a $2 million policy. And that should cover in the event that you pass away, your family can live off that for the next 20 years or so. 10 times is also fine as well of your salary. That's going to be the cheapest policy. I'm not against the life insurance trust. It's just that, again, does it really make sense for my need? And I would say a lot of times it doesn't. Again, being insurance licensed, I will tell you that the payout for insurance salespeople are very good on the complex products. The payout is not as great on the term life policies. So the term life policies are quite often not always shared because it has the least payout. And not that the other products are going to hurt you or going to be a disadvantage to you, but it just may be an expense that's not needed. I know that was a long-winded answer, but you can see how I feel about it. But this does come down to talking to a specialist. I'm not against them, so let me share that because again, I am insurance licensed myself, but it's a matter of asking some questions and asking some alternatives, and does this really make sense? And then the costs, and that'll be the last piece I'll share. We don't see the cost in an insurance policy. It's just taken from the premium, right? So you're not writing a separate check for a fee, but the fee is already built in. So one of the questions is try to identify what's the fee. So with some of the more complex contracts of insurance, there is the insurance piece, which you're paying for pure insurance. There is then the cash component or the investment component, and then a product fee or management fee, which can be significant, where you can maybe, again, just get the investment separately from the insurance policy and just do the term life portion and just invest the rest without that additional fee. So that's my answer on the insurance part.
If I can add just a second part to that, is there, for individuals who own property and have mandated insurance coverage requirements, is there a way to self-insure through insurance policy or some type of an insurance trust for self-insured?
Unfortunately, for property that has a mortgage side to it has to be through an insurer. The only way to really self-insure with your property is that mortgage is paid off. And then once that mortgage is paid off, it's up to us to ensure that we're putting funds away, whatever we would have been paying for insurance, putting that away, whether it's in a savings account or an investment, preferably to helping it grow. Because again, the insurance company is taking our premiums, and they are investing those funds, and so they are growing. So that's part of the way that they grow. Not only is it increasing the premium to us, right? That is a increased revenue for them, but then also taking that. But unfortunately, and I've tried myself because I'd like to self-insure. I do have a mortgage, so unable to self-insure. It is a absolute requirement, and if you don't, then the bank will place what's called force-placed insurance, which is at even higher costs than what we would be able to get ourselves out in the market. And so, unfortunately, we don't have an option for that, but I would say for many homeowners, if that property is paid off, self-insuring is a great way to go. Particularly again, I'm in the state of Florida. The biggest cost for insurance for us is wind. Wind basically covers hurricane. Our homes are not being hit by a hurricane and damaged every single year, but we pay that premium every single year. And there's not any reimbursement of any of that portion. The fact that there was nothing that occurred. But fire and other property damage liability, I would still maintain those. The cost of liability, the cost of fire damage, which is basically the standard home without the wind policy. It's a lot more reasonable in the cost. And so I would still maintain that, but I wouldn't worry about the wind portion or the hurricane portion. But liability is important. The other part with liability, someone's working in your home, they slip and fall, your homeowner's liability will cover that as opposed to the person coming after you. The insurer will also pay for the attorney, so you won't pay the attorney. So again, someone slips and falls, liability insurance will cover attorney's costs. As we know, insurance companies are not necessarily keen on paying out. They would draw out as long as possible. They will fight as hard as possible. So the insurance company will cover the legal costs. So if someone falls on your property, you don't have to go and seek protection out of your pocket for an attorney. So I would definitely, even with self-insuring, I would still maintain at bare minimum liability.
Okay. Thank you.
Perfect. I think it's one more question in there in the chat, and then we'll get ready to do the survey. Everyone, if you could look, I think it'd be put in the chat. If you can make sure that you do that survey. Mr. Colimon, I've seen one more question from Dr. Cambridge. I don't know if it says, let me see if I can get it up. Is there a minimum amount to invest in your products? And if you can also give us some information as to how to contact you, if anyone want to contact you after this program or at a later date, you can drop that in the chat and respond to that verbally.
You can reach out to me. That's the company email there, so you can reach out to me with any questions. I'll be happy to help. Is there a minimum? So with investing, luckily right now there's no minimums. Generally $50 you kind of get started in investing in almost anything that you want. I showed Apple, for example, just using a round number here. An Apple share is $250 per share. If you only have $50, there's now what's called fractional shares. So your $50 will buy you a fraction of that one Apple share. So the friction that used to exist in investing is no longer there. Prior to, you had to call into a broker to place an order. That one phone call might have been $70, $75, $100, depending on who the broker was. At some point, we moved online, and the online cost was reduced. That was maybe about $30 or so, but you still had to buy a whole share. Now there's no cost per share any longer. The only cost that you incur is if you have a professional that's managing, then you, at that point, will have a cost. The minimums, let's say working with a professional advisor, are going to vary. Your options with working with the professional advisor is planning. There could just be a base planning fee. It's a one-time fee. That planning fee will cover your income, your assets, your debt, your credit picture, taking all of that into account, and then looking at what your goals are for all of that. Again, those goals are going to be short-term, intermediate, and long-term. So you have a planning fee, and that could just be base planning. You now have a plan, you have a guide, it's a roadmap, and now you just follow that roadmap. So that would be similar to, let's say, working with an attorney. Attorney's going to establish everything, do all the work for you, give you that final document, and then you're off and running. The other option with working with an advisor is an ongoing relationship where you're meeting twice a year, once a year, depending on what your preference is. That is generally going to be based on a percentage of assets. And I'll give you the short version of that. Generally, let's say, just using an easy number, 1%. So if you have $10,000, your cost is going to be 1% of that 10,000. So what that would look like is, let's say your value went up from 10,000 to 11,000. You're not physically writing a check. It is just debited from the balance, that 1%. So I guess it's even, make it even simpler. If your growth was 10% that year, the firm would then receive still 1%. So in essence, your net growth would be 9% because the firm was managing everything for you. So your options are either just a flat fee where you're having a full plan. And with that plan, there's multiple meetings that are occurring to creating that plan, to giving it to you to just, hey, move forward. And then there's the investment piece where if you're working with an advisor full time, it would be 1% again of the overall assets. So dollar minimum. Most advisors under that process, it's generally going to be a $50,000 to $100,000 minimum, unless it's a high net worth advisor. A high net worth advisor is going to be $5 million or more. That's going to be their minimum. The high net worth advisor is generally also going to have an estate planning attorney on their team. So that's going to be a little bit different. The costs are going to be a little bit different there. But again, so there's planning, that's the flat fee. Minimum investment with an advisor, generally it's going to be 50,000 as far as assets being managed on behalf of the client. And generally the fee is going to be 1% annual fee.
Well, thank you so very much. It's been a pleasure. You are so informative, and that's what you do. So we appreciate you, Mr. Colimon. Thank you so very much from all of us, this collaborative event. And the chat, I don't know if we can get that survey up. And also, what else did I have here? Okay, there's that survey. If we can complete this survey and then take a minute to do that, and then we will have our final closing marks from our illustrious Vice Governor, Lady Bernadine Bush. So let's do that. Take a minute and let's do that. It's only 3 questions, and when you're done, please submit. Mr. Colimon, I just had a little simple question. Since this is an African-American organization that's been established since, I want to say the 1930s, Governor could correct me. Is there, I know this is, you may not want to do it, but is there a Black organization or a Black company that we can invest in that's really Black owned? 1935, okay. A Black owned company. I know years ago it used to be Johnson & Johnson, but and it was some other or products out there or companies out there, but I don't know what's out there now.
You know, as far as public that is majority owned, I can't say that I know a majority owned company that is Black, African American that can be invested in. Now, there is John Rogers, who owns a investment company, which his products are publicly available. Ariel Investments is the name of his investment firm. So it is 100% owned by him. His co-CEO is Melody Hobson, who Melody is Black as well. She is now a minority owner of, I think it's the Denver Broncos. She partnered with, I believe it may be the Walton family, the Walmart family, and has a minority stake. As far as that would be the closest. What his investment company does, he primarily focuses on investing funds for pensions, for insurance companies. That's his primary business. And I believe some of those products, those investment products are available to the public, but his business is primarily managing funds for insurance companies and for pension plans.
Vice Governor Bush, you're on the floor.
Here we go. Thank you so much. I'd like to say thank you to each of the individuals who came in and shared with us today. Thank you to the governor. Thank you to Deborah Allen as our host today. And thank you, Mr. Ralph Colimon, for sharing without hesitation your expertise and the information, which I know is and has enriched all of us today. As we come to a close today, I want to remind all of us that wealth is more than what we accumulate. It is what we activate. And the Wealth Multiplier is about intention, strategy, and legacy. Let me remind all of us that when professional women invest with knowledge and purpose, we don't just build personal prosperity, we strengthen our families, we uplift our communities, we create pathways for philanthropy and these experiences, this resource will last throughout the generations. I hope that you'll understand that today is not the end of a conversation. It is the beginning of an action. We call to action. Our call to action is simple but powerful. I'm asking all of us who are on the call, share the information with at least one person, and then individually, let's commit to one intentional financial step within the next 30 days, whether that's investing, seeking out a trusted advisor, educating yourself further, or supporting a cause that aligns with your values. It's important that we stay connected, continue to dialogue, and be active participants in building the legacy that you envision. I want to say as we close, on behalf of the Broward County Business and Professional Women's Network, in collaboration with the Jasper Club, the Greater Memphis Club, the Vicksburg Club, the TMAC Club, the South Florida Club, and the Miami-Dade Club, I thank once again each of you individually for showing up, learning in, and choosing to multiply your wealth with impact, and that will impact your legacy. Again, Mr. Ralph Colimon, we thank you. We hope that your phone will start ringing to get some more information from the women who are participating, to get more information about what you shared with us today. And I would also like to say again to our participants, if we answer the call today, we will begin to move forward with a purpose. And as our governor says, we will all be unstoppable. Thank you so much for joining us this evening or this morning. And I hope that you've been enriched by the experience.
Thank you. I appreciate sharing the information, and cut me off if you bring me back, because again, I can go all day with this. Okay.
No, you've been wonderful. Definitely wonderful.
Thank you so much.
Take care, everyone.
This concludes our program for the day. There's the results on our screen today. It's been a marvelous program. And thank you, everyone, Governor Baker and Vice Governor Bush.
Certainly. Thank you for your leadership today.
Have a wonderful weekend.
Thank you. Thank you all. Thank you, Mr. Colimon.
Bye-bye, everyone.
Down.
Hi, Nancy Butler, Shirley Jones, Angelique Dawkins. Joe Stevenson, Estelle Barr, how are you?
I'm good, and you?
Good.
Excellent.
All right, when the song ends, if they haven't hung up, I'm just going to end the meeting.
Control V. Control V.
State to live in right now is Alabama, and nobody